You pay your subscription once a year because most businesses cannot function without them. This is not advertising revenue. This is deeply entrenched defensive revenue. They are more recent listing, but they're playing in a very different space. So first of all, there's the direct consumer. For a highly branded apparel company, the direct-to-consumer model works superbly, which is screen time. As human beings spend more time on screen, we're talking through a screen. Everyone consuming this content is staring at a screen. The one thing that is happening is screens are destroying human population's eyes. And therefore, the percentage of our problems in the world is outpacing population growth. It doesn't matter on the economic cycle. People spend in this space if they need it. But this space has huge barriers to entry because we are so sensitive on it, because it's medical, because it's regulated. There are only a handful of players on planet Earth in this space. You're not going to trust just anyone here. Making money is not boring.
That is very true. It is not, especially if it's easy with boring companies. Anyway, getting to your US stock picks. The first US stock pick, I don't even know how to spell or pronounce or what they do. So please introduce that first one and what they do and also why you like them.
So that's a very that's a very open-ended introduction to the stock. So globally we can talk very at length on these stocks, but I will keep this very, very short and just bite-sized. Given the length we've spoken about the domestic stocks. So the first one we like is Bausch Lomb in the eye care sector. We also actually like Alcon for different portfolios and different mandates. But first of all, the eye care sector with contact lenses and solvents and surgical is deeply defensive. If you need eye care, you're probably going to go and spend the money and use it. Our primary sense as a species is eyesight. And therefore, it doesn't matter on the economic cycle. People spend in this space if they need it. But this space has huge barriers to entry because we are so sensitive on it, because it's medical, because it's regulated. There are only a handful of players on planet Earth in this space. You're not going to trust just anyone here. So really the major players are Alcon, Cooper's companies, Bausch Lomb, J&J is a subsidiary. And there might be one or two smaller regional players, but really it's the big major players that capture this. Bausch Lomb we quite like Alcon is the quality in the industry, but it is slightly higher priced. It's put out good numbers. Bausch Lomb is a unbundling, so it's a spin-off, and the spin-off has just gotten the new CEO. They're going to clean up the business, and that was part of the value unlock from the spin-off. There's still a lot of mess in the numbers, but if you work through the noise, it looks like over the next couple of years, first of all, I haven't touched on one of the tailwinds in the industries, which is screen time. As human beings spend more time on screen, we're talking through a screen. Everyone consuming this content is staring at a screen. The one thing that is happening is screens are destroying human population's eyes. And therefore, the percentage of our problems in the world is outpacing population growth. So there's a long-term tailwinds, not just defensive, it's actually a growth industry. And there's very few players in this. But in this, Bausch Lomb as a spin-off is cheaper for more risk-orientated mandates. We like using Bausch Lomb for the more defensive mandates. We'll trade into the quality being Alcon. Both of them are really attractive in this space, and both of them are worth looking at and understanding.
Very interesting, I must say. I can testify with the eyesights and, the more time we spend on screens. So that is an ever-growing market. Because too much time on screens without glasses also gives you headaches at times, so definitely looking into that one. The second one is more for the stylists. You asked me beforehand, if I know the brand, but have I looked into the company, and I have not, so quite keen to hear more about this one, and that is Levi Strauss. Why did you pick Levi Strauss?
Sure. So Nike perfected the direct-to-customer market and has proven how it works as a solid addition to a global apparel brands, or in their case, shoe. I would argue apparel brands because there's lots of products that aren't shoes in Nike. You capture more margin, you control the experience at a consumer level, and you can still work with wholesalers and everything because you're such a powerful brand, and it's all win-win. And the Nike's proven that model. Levi Strauss is much earlier in that transition. They are more recent listing, but they're playing in a very different space. So first of all, there's the direct consumer. For a highly branded apparel company, the direct-to-consumer model works superbly, especially if you've got a global footprint and you can leverage that scale and volume, and especially if your brand is known to consumers. And someone like Levi Strauss with over 100-year history that literally invented the jeans category. They invented denim and the jean category in the world. You can roll out your brand globally as they are doing. They're under-indexed globally. There's a natural growth path with very little brand spending as you just open up and grow that channel. So Levi Strauss, earlier in that, they're using the Nike playbook, but in a very different space. So what is their space? Well, whereas Nike's branded athleisure, Levi Strauss, first of all, in the jean category, in the denim category, but they're moving into other being jackets and T-shirts and shoes. They've recently acquired a yoga pants company. I forget the name, sorry. But all of these are plugging in. What it really is the casualization space. And everyone, well, they're stuck in their houses for 2.5 years, got used to not wearing suits. I would take a pretty good guess that below the frame here, Higgo, you're not wearing suit pants. Like, if anything, you're probably wearing jeans.
No,
most
it's
people
actually short pants with pluckies.
There we go. But the casualization, I went to a couple presentations and stuff in person, meetings earlier this week, and I wore a tie, and everyone commented on why am I wearing a tie. And it's a fair point because no one's wearing ties anymore. So there's a casualization tailwind in this space. It's not just and the natural beneficiary of this are the jeans companies, and the natural winner of the jeans companies is Levi Strauss as they're internationalizing and they're growing the direct to customer. So long term, they're wonderful. They just need to trade out through what is potentially a year with a recession, pressure on consumer disposable income. But ironically, as consumer income has more pressure, what tends to happen is they tend to focus more on the brands they trust, and it's actually the marginal brands that get hurt. Because if you've got a budget to refresh your jeans, and you need to buy a new set of jeans, are you going to take a risk on rubbish jeans and have to go and buy a new set of jeans? So the big trusted quality brands tend to win out of this, of which Levi Strauss is number one. And all of this is sitting with a company that is still owned by the original family. It's they still have the controlling votes in the company. It's the A shares that are listed. So you've got long-term people. They're building out the brand into other categories. So you've got the leverage effect of building out breadth and depth in terms of product range, leveraging the brand. And it's all sitting on what is a lowly geared, effectively net cash company balance sheet. And it's sitting on a 12 times price earnings. I think if you can see through the cycle, Levi Strauss is a fantastic stock to pick up at these levels.
Very interesting. Your next pick is in the semiconductor industry. Currently, I'm also a big fan of ASML as well as AMD. Nvidia, not so much. It's just too expensive, but great company, as many US companies, for my personal liking. But your pick is TSMC, so Taiwan Semiconductor. Why did you pick this one? I know this one is also in many emerging market ETFs. So, if you own one of those ETFs, you probably have Taiwan Semiconductor. But why did you pick this one as an individual stock?
So I won't get too technical. I'll be the first to admit that I don't understand all the positions along the supply chain and all the technical details of semiconductors. I'll be the first to admit that. We've got a guy on the team who does, and he likes TSMC. Simplistically, though, they are mission critical to the supply chain of semiconductors, especially where they play. Unsubstitutable. They are absolutely winning. The fact that Intel has outsourced some of their production to TSMC speaks volumes about what these guys can do. They are amongst the cheaper of the semiconductor plays, most notably probably because of their Taiwan exposure, and that has geopolitical risk. I mean, what happens if China invades tomorrow? But over time, they are swinging their supply chain to be far more global. And in fact, they're sinking factories and production lines into America with massive incentives from the American government. So the balancing the geopolitics with the valuation, with the mission, with the supply chain critical, unsubstitutable elements of TSMC, we think it's an attractive stock to hold. You've got to see through the cyclicality. You've got to see through the noise. If Taiwan never gets invaded, you're getting a cheap stock. If they do, over time, that risk is getting diversified out in TSMC. And in fact, if they do, TSMC is arguably critical to China too. I mean, will they necessarily expropriate it in some outlier invasion event? That's harder to say. Probably not as well, because they can't produce that. So it's mission critical, and it's a space where one has got to take a view. Couple that with Renogen and the helium space, and like you got to have forward future-proofed businesses along the supply chain, ones with pricing power as opposed to ones that are price takers.
Interesting. And then getting to your last pick for the offshore holdings, if you missed the previous ones, you can forward to you can rewind to the JSE picks. But the last one is Microsoft, so a bit of the artificial intelligence play. Must say, it is an extremely well-run company, and ChatGPT, it's quite interesting. I use ChatGPT 2-3 hours a day. It works with everything. It even helps with marketing ideas. It's an incredible product, and obviously Microsoft benefits from that and that uptake. But why did you choose Microsoft?
So first of all, the AI element in Microsoft, they're best positioned to win. We think they're partnered with the best. It's about implementation and embedding it, and they've been building up to this for a while. No idea how to value it. I'm not going to comment on it. It's free optionality, free potential upside. If anything, it builds resilience in the business, builds traction going forward. In the background, if you look at the majority of big tech, monetizes their platforms through advertising. Advertising is cyclical. Now, the reason these businesses haven't appeared to be cyclical in the past is because they were winning market share from the offline advertising. But the majority of advertising now happens online, and therefore they will start to track the advertising markets. And hence be cyclical. And how much would you pay for an advertising agency? A well data enabled one, but Google, Meta, these are advertising agencies, largely. Microsoft is very different. They have an advertising element in their business, but the core of their business offers largely unsubstitutable, inelastic products and software to businesses and people. Outlook, Microsoft Office, Windows, these things. You pay your subscription once a year because most businesses cannot function without them. This is not advertising revenue. This is deeply entrenched defensive revenue. And as an inflationary environment bites, you can you have pricing power in this space. So Microsoft is well positioned, and they're not. You cannot compare big tech with the same brush. They're just not. Amazon's largest business is loss making. That's the e-commerce side. What value do you put on that?
I didn't even know they have an e-commerce business.
Yeah, everyone talks about their cloud business, but their e-commerce business is like single-digit margin loss leading business. And can they unpack that from their cloud business? Because the one subsidizes the other. So these are not the same quality businesses. You cannot compare them with the same brush. Microsoft is vastly superior, vastly more defensive. AI is just an embedded option in the business. And then especially if you can pick up Microsoft on a free cash flow yield that is close to or above the US 10-year bond, which at this point they're not trading at it, but previously we were buying heavily when they're trading at 220 as a share price. They're trading closer to 250 now, and the US dollar 10-year was trading closer to 3%. That was a very attractive moment. US dollar has gone closer to 4% now, and Microsoft has rallied, and it shows that that approach is, I would rather hold Microsoft for 10 years than I'd rather hold than the US 10-year yield. US 10-year bond for 10 years, and that's the way to think about it. So yes, of the big tech, that's the one we are bullish on.
Very interesting. Thanks so much, Keith, for all the insights.